Good afternoon, everyone. I am Sensei Kevlar. Welcome to the first day of the Dojo. Here, we are going to learn how to make ourselves profitable in any market, in any situation, in any opportunity. We're going to do that by learning how to create opportunities for ourselves in these markets, by creating a plan and then trading that plan. So, what I'm going to do is I'm going to start by coming to one of my favorite... let me just start by backing up and saying, when I come to a chart like this and I start doing something like drawing on it or looking at it or trying to figure out what the chart is doing, that's called technical analysis. Technical analysis is looking at the historicals of the charts and looking at what the market is presently doing in order to try and make predictions about what the market might do next. Now, when we're doing historical analysis, when we're doing technical analysis of a chart, what we're trying to do is we're trying to figure out what the possibilities are. We are not trying to actually predict the market. We're trying to figure out what the possible avenues of motions are, and then we're trying to build a plan based upon what the market may or may not do. And what I can tell you about predictions with regards to markets is I can absolutely predict 100% that the market is going to do one of three things every single time. It's going to go up, it's going to go down, or it's going to go sideways. And beyond that, there is no crystal ball. There is no way of staring at the charts long enough and drawing enough lines and using enough tools to accurately predict which way the market is actually going to go in any direction with any reliability. The other way of thinking about these things is fundamental analysis. And fundamental analysis is about looking at the reason that a market exists at all. For instance, Bitcoin exists because Satoshi wrote a white paper and a bunch of people started dedicating CPU power in order to mining and creating this network, and this network has intrinsic value, so they propped it up and started trading on it, and ever since then it's had this meteoric rise in price over time, which we've talked about before. So the difference between fundamental analysis and technical analysis is technical analysis, you are looking at the past and you're trying to decide what the future will do based upon the past. Fundamental analysis, you're looking at the reason for the speculation in the market, and you're trying to decide if that speculation is valid and which direction that speculation will continue in. Many schools of thought favor one over the other. I'm going to tell you that I favor neither. They're both tools in a toolbox. Absolutely, what we are going to learn here is how to use tools from a toolbox. The way of the trader is about getting out the right tool and applying it at the right time in order to make the right decision, in order to inform the right plan, and then plan that trade. And at the end of the day, both fundamental and technical analysis can fail you entirely. So it's important as we go through these basics of technical and fundamental analysis that we understand that these are not crystal balls, these are not predictors in any shape, in any way that we can rely upon them to do work for us. Instead, we have to do the work of preparing for them to be wrong. And part of what we're going to learn in the dojo is how to learn how to plan for them to be wrong. So what I'm going to do is I'm going to come up here and I'm going to type into my search bar. I'm going to go to tradingview.com, and a lot of people ask me, do I need to pay for TradingView? I do, because I use it enough to where I feel pain with it. In the beginning, I certainly didn't. I used their free offering, and I became very competent with their free offering, and I really suggest you do the same. It isn't until you get really annoyed by the pop-ups and the lack of indicators and the lack of overlays that you can, the lack of successive overlays, you can only do like 3 or 5 indicators or something in the free plan, that you kind of go, well, I'm using this to make money for myself. If I'm making a lot of money for myself, can I afford their $19.95 subscription for the month? Yeah, probably. That makes sense. But I really don't suggest that you spend any money solving a problem that you don't first have. So come here, go to TradingView, go to any website that you like to do, or any charting site that you like, any charting tool that you like to do your technical analysis. Doesn't bother me. What you really want is you want the ability to be effective and share these things around, because as I reminded you at the beginning of our orientation, it's very important that we're working together as a team, and TradingView has a lot of cool tools to allow us to share that information around, and provide us with opportunities to work as a team together. So what I'm going to do is I'm going to come up here into the search bar, and I'm going to type in BTC USD. And what I can see is that I have a number of options here. I have a number of exchanges across which BTC and USD is traded. So I'm going to choose the one that I happen to be trading on at the present moment, which is Bitfinex. And I'm going to come here and I'm going to click on that, and it's going to offer me an interactive chart. I'm going to click on the interactive chart, and that's going to bring up a new window for me. And here, what I have is way too much information. So excuse me for just 1 second while I delete all of this information, because initially you won't be seeing this. This is sort of what we're going to get to today, is drawing on the chart and figuring out how to look at the chart and draw on it effectively and make decisions using those drawings. So what I have here is I have a chart of Bitcoin traded against dollars. This is a 4-hour chart. What that means is that what I'm going to do is I'm going to scroll in using my mouse wheel and just drag this thing over here. I'm going to scroll in some more using my mouse wheel. And I'm going to take us right up to today is August 2nd. Here we are in August 2nd. And what each of these lines here means, these are called candles. And what each of these lines here mean is these are a historical price of the market. And then this red line right here is our current market price. This is the bid or the bid-ask order books. We have 4,358 on the bid and 4,358.01 on the ask. So that's the current market price that we're showing right here. And then this is historically where the price has gone. This right here is a candle. This is a green candle. So what we're saying here, let's find a nice green candle. There's a nice green candle. I like this one right here. We're going to study this green candle for just 1 minute as part of our intro to technical analysis. The way that a green candle works is at some time at the 4-hour mark, beginning of the 4-hour window, we came in here at this price right here at the bottom of our green candle. At some time, we went as low, within this 4-hour window, we went as low as this wick right here, this wick below the candle, this green wick right here. We also went as high as this wick right here above the green candle. So these are the highs and the lows of this 4-hour window. And then finally, at some point during this 4-hour window, having gone up to here, we came back down and we closed out at the top of, we closed out this 4-hour window right here at the top of this candle, at which point we minted the next candle over. Now, the red candle works in exactly the opposite way. If the candle is green, we started at the top, started at the bottom, and then we ended the session, the 4-hour session, higher. A red candle means the opposite. We started the session up here, and then we came all the way down. At some point, we thought we might have gone up, but then we came all the way down to this red wick right here, to this low right here, before coming back up to here and closing out the 4-hour session on this red wick right here. And then we opened up this red candle right here, and we went up all the way to the extreme, we went down all the way to the extreme, and then we closed out the 4-hour session right here. Up, down, down, up, 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 down, up, down, up, down, up, down, down, up, up. In this way, we can measure the motion of the market. More green means more up, more red means more down. Now, what we can do is we can divide this across different time frames too. We can say I want to view this across a 1 hour time frame. So I'm going to come in here and I'm going to click this and I can select the different minutes, or I can just type it in. And now what happens is each of these candles represents a 1 hour roll up of our price window. So I'm just going to zoom in here so you can sort of see there's a lot of candles here. This is the 1 hour chart, and there's a lot of jaggedy information here. You're getting a lot of detail. But if you roll this up to the 6 hour chart, well, you're seeing exactly the same price information. You're just seeing it with a lot less jaggedies, because each window, it represents a lot more time, which brings in a lot more information into a 6 hour window. So it's the same information over different time frames. We could look at the 1 day chart. Here's the 1 day chart. You can see that it just becomes more compressed in the candles. The 1 week chart. The 1 week chart becomes even more compressed in the candles. I generally like the 4 hour chart. The 3 hour chart is one of my favorites in these markets. The 6 hour chart definitely works very well. Whatever it is you're doing, all of these time frames are valid ultimately. People ask me what's the smallest time frame I use. I don't go below the 1 hour chart ever. It's noise. If you're looking at the 15-minute chart, you're not really seeing the big picture at all. You're getting a very, well, it doesn't even have it on this one. I'm not sure what's going on here. I'm sorry, this is the 15-month chart. You're not seeing the big picture at all. You're not getting the big view. You can't even fit any real detail into here. You just have this sort of constant line of noise. No matter how much you scroll out, you're not really getting the detail that you need to see what's going on in this market at the 15-minute window. Here is, we got to come back. Here's, this is a lot of noise, and you can't really see the long-term trends on this window. So take it out to the 1 hour view, get a bigger picture, think longer term, work on a reasonable time frame, because otherwise you're going to really get confused by this. I think somehow we moved off of Bitrix. Where's Bitrix? Right there, Bitrix. Somehow we moved off of that one. Let me get rid of all this crapola again here. Or let me just choose something else, BTC USDT. There we go. Now, what I want to point out to you here, and the reason that these lines keep on showing up in my charts, is that whales and traders and everybody in the ocean, in the sea, is looking at these charts and trying to figure out how to make money in these charts, with these charts. They're sitting here doing this technical analysis, reading the charts, and the first thing that they're doing is going, oh look, the market is going up. Let me buy some and then I can sell it up here and then we'll be profitable. And immediately what people run into is they run into a problem, because they buy it down here and then the market goes up on them and then they don't sell. And they get up here and they're going, look at all of the money that I made. And then the market does this on them and suddenly they're unhappy. Well, that wasn't a very good plan. You should have had a better plan for that, right? If you decided that you wanted to take some profits in this market, you could have had a plan in place for buying, this dip right here and taking your profits right here. Well, what would have happened if you did that is you could have come back down here. Let's say that you sold out at 3,700 because, your plan was to take 10% in this market. Well, here's your 10%. You wake up the next day, it's 10% higher. Time to do your sale, guys. Time to take your profits. Nobody ever went broke taking profits. Okay? Because if you wake up in the morning and you're selling out at 3,800, well, guess what? It comes back down to 3,500. You can buy them all back cheaper, $300 cheaper. Then the market goes up again, and you can sell them at 10% profit. You wake up in the morning and look, it's 10% profit. Here we are, 3,900. Well, if you had a plan in place for selling them at 3,900, you could buy them back at 3,500. Well, what's your plan for selling them out in 10%? There you go. There's your money right there. Can you wait for it to come back down to here? Buy them back at 3,500? Make money like that all day long in this market? Sure, if you have a plan to do so. And that's where it begins, is making a plan for profitability. When we trade markets, we must decide ahead of time what it is we're going to do when the market goes up, and what it is we're going to do ahead of time when the market goes down. This is an even more important aspect of this, because if you bought in here, you could simply set your sell limit order in the market, go to sleep, and wake up in the morning and find out that the market has come up on you all the way to here, and you made your money right here in the market at $4,000 because you bought in at 3,600 and you're hoping for 4,000. And you wake up the next day, well, look, you just made $500 on that trade if you did it with a Bitcoin. $500? Can we do that over and over again? Sure. Here's the problem. You think you're going to do it right here, or you think you're going to do it right here, and then this happens to you. This is where you're holding a Bitcoin, and it sinks away from you. And this is how you become a bag holder. Sort of the classic phrase, right? So what can we do differently if we think that the market could do this, or we think that the market could do this? Well, the first thing that we can do is not sell out the entire Bitcoin right here. We could not we could not buy back the entire Bitcoin right here. The reason that we would do that is, what if the market comes down more on us? Okay, let's use some imaginary numbers for just 1 second here. I'm going to come in here and I'm going to take my drawing tool on my left-hand side, and I'm going to put 2 horizontal lines into the market to represent a concept. Follow along with me. What I'm going to do is I'm going to say that this right here is $20. Oops. And this right here is $10. If I buy here and then it comes down on me, my position is only worth $10 now. But if I buy here, I now have $20 worth. Okay? Now, if I spent $20 up here and I spent $10 down here, what that means is that my dollar cost average for my position, if I bought 1 coin up here at $20 and I bought 1 coin down here for $10, that means that I have 2 coins at a cost average of $15. The reason that I say that is because if I come over here and I say 20 plus 10 divided by 2 for my average is equal to $15. What I'm going to do is I'm going to come in here and I'm going to say, this is my new profit line right here. $15, the $15 mark in between. Remember, we're using made-up numbers here, just to make the math easy on us. If I were to buy 1 coin here, and I were to buy another coin here, my coins would be worth $15 a piece. 1 coin that I bought here and 1 coin that I bought here, because the average of what I spent is on each coin is $15. What that means is that this motion right here made me profitable right here. How much profitable? Well, right now I'm looking at 3% profit. Okay? So, if I had bought up here and I didn't have a plan for buying right here, I couldn't be making money right here in the market. This is the beginning of planning, right here. We plan for the market to come down on us. We know that it will. Eventually, this trend will turn around. Eventually, our luck is going to run out. Eventually, we're going to buy here, and then it's not going to do one of these on us. Eventually, we're going to buy here, and it's going to do one of these on us. At that time, we better have a plan in place. We're going to buy here, we're going to buy here. Okay? Well, if we're doing that, why would we not just buy here? Say this is, $5. What we're doing is we're dragging down our position cost. It would now be halfway in between this point and this point, which is about right here. Okay? So, let's look at the plan again. If we had bought here, and we had bought here, and we had bought here, what size motions are these? Well, these are 14, 15% motions right here, 15%. If every time the market came down on us 15%, every time our position sank away from us 15%, we doubled up our position. We bought one coin here, we bought one coin here, which would double our position. We would need to buy 2 more coins here to give our grand total of 4 coins. At that time, our new profit line would be halfway in between this line and this line, which is this line right here. And look at what happened. Can we be profitable on this leg of the journey? How much? 20% profitability. Now what I'm doing is I'm coming here and I'm holding down Shift and I'm clicking and I'm dragging up and to the right, having clicked with Shift. And this is just showing me, number one, in 9 days, I could have made myself 20% profitable off of this position right here. This is the beginning of planning. Is we plan that the market could go up from us and give us profit, but it also could go down from us and take away that profit. But if we have a plan in place, instead of taking away profit, what we're doing is we're doing opportunity generation right here. Right here. We could have sold it, bought it back. Sold it, we could be waiting to buy it back down here. In this way, planning makes us profitable even when the market goes away from us. This is really, really critical. Dollar cost averaging down your position allows you to ensure that even as the market sinks away from you, you can still take advantage of even the most slightest upward motion. We never return to here. We've not made it up to here. We bought at the top of the market. We are selling at the bottom of the market. And we're being profitable. So that's a real difference than the strategy that we were using before of buying here and then waiting for the market to go up on us and selling. The reason that we can't use this strategy is it's not reliable. This strategy doesn't work half the time, or a third of the time. 1/3 of the time the market goes up and it works. 1/3 of the time the market goes sideways and nothing happens. 1/3 of the time the market comes down. Well, I don't like strategies that only work 1/3 of the time. I want a strategy that works all the time. So I'm going to ditch this strategy. I'm not going to trade this strategy anymore. I'm going to trade this strategy instead. I'm going to say, in order to ensure that when the market comes down, I'm able to do a bunch of buying as the market comes down, I'm going to start up here with a very, 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 very small position. 0.001 Bitcoin. This forms the foundation of the plan, and what we're going to do is we're going to say, in order to remain disciplined to the idea that the market will come down, we are always going to start ourselves at the smallest position possible, 0.001 Bitcoin. Now, if you're working with a large portfolio, I know this doesn't sound like a lot, but I need you to bear with me, and I need you to become disciplined to planning and stop losing money, because this strategy really will pay off long term. And it's not going to look like it in the first day or maybe even the first week. But when you really stick with it and understand the entirety of the fighting style, it really does work. Here's the thing. We have to be prepared for the market to go down on us. In exactly the same way that diversification was your armor and, proper accounting was your dodge, well, this is your block. When a punch is thrown at you and when all of your profits are taken away because you thought you were going to go off, you had better be prepared to block that punch when it comes flying at you. You had better be prepared to buy here and here if you bought up here. The only way that you can possibly do that, and the only way that you can possibly be doubling down your position every single place down here, and now you can see where the lines start to come in, is if you started with a really, really, really small position up here. That's the only way the strategy works. So you must become disciplined to the idea that the only way to make yourself profitable is to start small and then create opportunities when the market comes down, rather than being greedy and hoping for luck up here, because you won't get it. Maybe you'll get it, maybe you'll get lucky. And if you want to get lucky, take your money to Vegas. Vegas is fantastic. It's like an adult playground. So much fun. I'm talking about serious profitability, and if you want serious profitability, you will stay disciplined to a plan. And a plan ensures that you're going to be profitable even when the market, I'm going to use a different tool here. I'm going to come and take my trend line tool. I'm going to project what the market might have done. Is the market might have done this, followed by which time it might have done that. And that would have been your opportunity that you should have taken advantage of right here. If you had been buying down your position the whole way and dollar cost averaging down your position the whole way, well, guess what? You'd be in a much better shape today. You'd be making money on this leg of the journey right here. You'd have bought at the top of the market, sold at the bottom of the market, and been 15% profitable on this leg of the journey right here. You must have a plan in place for this. What's more is, look at where I am. I'm down here at 1,800 in this market, where the market is presently up at 4,000. Did you plan to lose this much money the whole way down and then make all of your money at the bottom of the market? I certainly hope so, because what I'm going to tell you is that these things happen to these markets all the time. Here's Dogecoin coming on down. Look at the lift up. 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 If you had a plan in place that had you buying down your position to right here, you could have made a 12% lift off of this. You could have made a 16% lift off of that. You could have made a 28% lift off of this. You could have made a 42% lift off of this market right here. You could have bought here, sold here, and made all your money. This is what a plan will do. Okay. Now, how do we make a plan? What we notice is that in these markets, especially, BTC, USDT, coming back to that old cat. What we notice in these markets, without me having come in here and accidentally done them ahead of time, muscle memory, I tell you, this is why it matters, is you just do it without even thinking. Okay? Is when traders are looking at these things and they're looking at these markets and saying, oh, look, the market is going up again. When the market goes up and then it turns back around again, like it did right here, it did a nasty turnaround back again, we call that resistance. When the market is going up and it turns around and it smacks up against this line, we call that line resistance. And then when it comes back down and it turns around in the other direction, we call that support. Going up in the market, resistance. Coming down in the market, support. Okay? Now, what traders do is they're looking at this and they're going, well, this is interesting. Previously, the market was trying to go up and it encountered resistance right here at the $756 line. Then it came back down to $690, went up, almost touched resistance, came back down, went up, touched resistance, broke through resistance. As soon as it broke through resistance, look at what happened right here. I'm just going to zoom in on this a little bit more. Look at what happened right here. Where previously resistance occurred, when we were trying to come back down, this same price point right here, the same line in the market, became support. We went down, we found support, and then we went up again. Later, when we were doing this again, we were coming down, and we found support at exactly the same line. And then we went up again. Here, we found resistance, and then we went down again. We came up, we broke through resistance, and resistance became support, and we went up. When we were coming down again, it became support again, and we went up. Down, broke through support. Look at that motion right there. As soon as it broke through support, it tried to make a return. Support became resistance, and we went down again. Up, resistance, down, break through resistance, come down, support. Over and over and over in these markets again, you will find this trend. This idea that when it goes up and then turns around, this is a psychological price point at which traders are going, I like my profits at this level right here. I'm going to sell and take profits. I like this level for my profits right here. I'm going to sell and take profits. Having sold and taken profits, like I've been talking about, they are, of course, going to buy it all back cheaper. Got all this new money that you made. Why would you not buy it back cheaper, only to sell it and take profits again, in a repeating cycle of making money? Look at where it happens, though. If all of the traders are sitting here looking at the support and resistance lines and figuring out where the support and resistance lines are, and that's where they're doing their buying and their selling, here they did their selling, here they did their buying, and it went up. Okay. Well, then, at this point in time, it went up and it found resistance. Excuse me. I'd like to use my drawing tool, please. It found resistance. Look at what happened when it came down. It found support. Look at what happened when it came down. It found support. I mean, this is just, it's getting repetitive at this point. You can actually predict that these price points are fairly certain points at which the market is going to turn around. Does it always do it? No, certainly not. Does it always, stop at resistance and turn around? No. Sometimes it breaks through resistance and then resistance becomes support. Can we plan for the market going in either direction? Can we plan for it stopping and turning around here and going down versus planning for it to do this right here? Yeah, if we know it's going to, we can certainly make the plan for that. This is the essence of planning. Here we found resistance, resistance. There comes a point at which I don't even have to draw them anymore. Resistance, resistance, resistance. Here we found support, support, support. I'm not seeing any more really relevant lines in this market. But just by going through and tagging all the tops and bottoms, all the places where the market turned around historically, right here, if I tagged it right here, and I fast forwarded in time, if I tagged it right here, and then I fast forwarded in time, if I tagged it right here, and fast forwarded in time, once again I tagged it right here, fast forward in time, well, look at what the market told me about the future when I tagged it in the past and projected that trend line forward. It told me the places where I might want to consider buying down my position here, 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 before it went back up again. And look at what happened. The market was coming down, and you think this was a previous historical line that somebody had tagged and then projected forward for their buy point? Well, yeah, we were coming down, and look at what happened. We paused. We went sideways while we did that buying really fast, and then we went down again. At this point, this guy was pretty pissed off. Time to come back up, he said, so I can make my profit. I want my profit. I'm going to do more buying down here in order to dollar cost average my position downward, get it down to here, and make all my money on this motion right here. Get it down to here, make all my money on this motion right here. This sets up our homework for the next 2 days. Number 1, find your favorite coin. Go back in history. Look at the chart historically. Look at the technicals. Look at the price points at which the market goes up, finds resistance, project it forward. The market goes down, finds support, project it forward. Then go see if those historical support and resistance lines are respected again. What we should be doing is we should be training ourselves, building this muscle memory to create these historical support and resistance lines to see where the market is going to turn around. The reason that I need you to do this, the reason that I need you to sit here and draw these lines over and over and over again, is because it's going to build your muscle memory. At the point at which you can look at the market and go, oh, look, it's going to turn around right here without drawing the line, that's because you've drawn the line enough times to know that it's going to turn around right here, and you know that this line is going to be projected forward. You can see it with your eyes. If you can't sit here and find these lines using these lines, using these drawing tools, you're not going to be able to do it with your eye. Start with your tools, post your charts in chat. In order to share your charts, what you're going to do is you're going to sit here and you're going to draw your lines, and then come down here and push the camera button, copy this URL, and then just paste it in the Discord chat. Say, hey, check out these lines. Is this right? Have I found the correct correlated levels? What you're looking for is you're looking for places where the market turned around, going up, and then later turned around going down. That's a correlated resistance and support level. Those are the lines you want to find, because those are the lines you want to schedule around. You want to say, when it comes down to here, I want to allow myself some more buying. But if it doesn't come down to here, I'm not going to buy this much. I'm going to save my money until it comes down to here, and to here, and to here, and to here. And I'm going to make a plan to start up here with very, 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 very small amounts. And then as the market comes down, I'm going to save my money to buy more and more and more and more and more until the market comes back up on me. So that's the first part of your homework. The second part of your homework is doubling down. If I buy one position here and I want to double down here, if I buy one position here, here's my profit line. It needs to go up from here to give me profit. If it comes down and I say, oh look, I'm at a historical resistance line, I think this might turn into support for me. Let me go ahead and double down my position, which means I buy, if I bought 0.001 BTC here, I would buy 0.001 BTC here, because that would double my position size. Okay? What that would do is that would dollar cost average me to a profit line of right here. Then I need to do it to here, and I need to figure out what my dollar cost average is. Then I need to do it to here, and I need to figure out what my dollar cost average is. Get out your pieces of paper, get out your calculators, start writing down the numbers and figuring out if I bought one position here, two positions here, 4 positions here, 8 positions here, 16 positions here, 32 positions here, 64 positions here, and each position is 0.001 Bitcoin worth, how much money do I have in the market when the market comes all the way down to here? What percentage of my portfolio allocation is that? Is that 10% of my portfolio? Is that 100% of my portfolio? How much of my portfolio have I spent buying Bitcoin or Dogecoin or whatever coin when the market comes all the way down to the bottom? If I'm doubling up, one position, 2 position, 4 position, 8 position, 16 position, you're buying double the amount of positions each and every level. Now, go back and do that again, except instead of doubling up, try tripling up. Instead of buying one position here, making your profit line here, when the market comes down, buy twice as, or triple up your position, which means buy 2 positions, okay? Instead of, or buy 3 positions, that would be a quad X, right? So if you buy something at $20 here, and then you buy 3 positions at $10 here, your new profit line, instead of $15, is now $12.5, because 20 plus 10 plus 10 plus 10 divided by 4 is 12.5, not 15. In this market, if I had been simply doubling down, I wouldn't have gotten my profit right here. But if I had been tripling down or quadrupling down, I could have gotten my profit. How much profit could I have gotten? Well, if I had a plan in place, I could have gotten 5% profit off of this lift. Well, maybe I didn't want 5%. Maybe I wanted 10%. Come all the way back up to here. Give me 8%. Didn't happen. Well, I better have a plan in place to buy here and here and here. Look at that wick come down. The market absolutely made that price valid for just a second. If you had a plan in place, if you had a market order in the market, if you had gone in here and said, well, I'm going to buy 4 positions here and 16 positions here and 40 positions here and 90 positions here, and figured out exactly what your allocation of your portfolio is, then you would know exactly how much more up you would have had to have gone. Now, you don't need to get into the market to do this. Get out a piece of paper, get out a pencil, get out your calculator, write down these numbers. Write down 20, 10, 10, 10, divide by 4. Do the math. Do the math so much that you're doing the math in your head without the calculator. And when the pencil cramps in your hand, you will know the pain that is required for a change. Maybe instead of a pencil, a spreadsheet might be a better option. A Google Doc, one of those. You go to Google Docs. You go to docs.google.com. You come right here and you click this button and you make a new spreadsheet. And you start typing in your numbers here. And you start doing your numbers right here in your calculations. So you can sit here and figure out how to do this. You need to be doing this in your head, though. This week is going to be about building our tools. I can't give you this tool. You need to become proficient at doing this yourself. You need to be able to look at this and say, oh, look, I'm going to double down, triple down. Here's my resistance. Here's my support. If you have questions, post them in the chat. Post them in the Discord. If you have charts to share, post them in the Discord. Share them with your fellow students. Share them with me. Share them with your TAs. At the point at which you are drawing these lines in your sleep, you're ready to move on. This is where I want you to get to by Wednesday, is that you can look at any chart, find the resistance and support lines, and know exactly what your schedule is going to be for if you're doubling, tripling, quadrupling down. Make spreadsheets. Figure out the numbers yourself. Share your spreadsheets with each other. Share the work with the group. A master trader is a master of his tools, and I can't give you the tools that will teach you how to do this in your head. You have to do this in your head until you feel the pain, and then you'll know what to do here. In order to create this, you need to come in here and type in these numbers and figure out if I 2x, if I 3x down, what's my position size, what's my portfolio size, what's my opportunity allocation, all the way at the bottom of the market. We're planning our downside opportunity creation. The more that we plan for opportunity creation, the more that these markets come down, the more money we can make for ourselves the minute that it turns around and gives us even a little bit of boost on us. But if we don't plan for profitability at the top of the market, we're going to be really unhappy at the bottom of the market. And that is the way of the trader. Thank you very much.